Good morning, navigation traders. We're going to get started here in just a second. Making sure my audio and visuals are all ready to go. Hope everybody had a great weekend. Looking forward to a great week of trading. Had a big announcement yesterday. The French elections, the first round of the French elections took place. And kind of the two that the polls were saying were going to happen, Macron and Le Pen. So that's what's definitely moving the markets this morning. So don't forget, every Monday morning we do this 8:25 Central right before the markets open. A couple announcements before we get started. We've got a new course coming out soon. We're really excited about. Got a ton of great content. Just putting the final touches on the editing. So I'm thinking 2 to 3 weeks out. Don't hold me to that, but should be coming soon. And I think you're really going to like this new course. Second, we've got a book that I'm kind of putting the final touches on as well. This should be ready next month. It's going to be an awesome guide for both new and advanced traders to use for the different strategies that we teach at Navigation Trading. So stay tuned for that. Look forward to that. And then still working on the newer lower commission rates. And I'm really hoping that we're able to get a solution for our international students. So for sure, for U.S. residents, we're going to have lower commission rates from two top options brokers, and then we're working on the international stuff too. So hope to have an announcement on that for you coming up. So don't forget this Navigation Trading Live. It's all about you. So if you have any topics or questions or things that you want me to talk about on the broadcast, make sure you send us an email or leave comments on YouTube or Facebook. We stream both from our Facebook page and our YouTube channel, and we would love to be able to cover topics that you guys really care about. So make sure you send those in. The topic for this week, and this comes from Christian, who asked, can you please make a video on options futures? Okay, so that's the topic we're going to cover right now. The market's going to open here in a couple minutes, and then we'll jump onto the platform and take a look at what's going on and go through our trade of the week. So, options on futures. Let's go to the platform and take a look at an example. So, what I'm going to show you is a couple things and kind of the difference between trading options on futures versus options on ETFs or stocks. And there's the opening bell. Still love to hear that every Monday morning. No better sound, right? To a trader. All right, so let's take a look at the S&P 500 which is the /ES on TOS. Okay, that's the S&P 500 futures, and we're going to compare that to SPX, which is the S&P 500 index, and we're going to compare that to SPY, which is the S&P 500 ETF. Okay, so we've got three different vehicles. We've got three different symbols, all three of which represent the S&P 500. Okay, so let's start with SPY because SPY is the smallest of the products. It's the smallest price of the symbols, and it's the smallest notional value. Okay, so what I did is to compare each, I set up a one standard deviation strangle on each of these different symbols. Okay, so what we're looking at here, this is SPY, and I did kind of going crazy there. On SPY, I did 10 contracts. Okay, and what you're seeing here is if you look down in this box, the max profit that we could receive on this trade was $1,480, right? We're receiving a $1.48 credit times 10 contracts. So $1,480 is our max profit, okay? So what we know, or maybe you don't know, but what you should know about the futures contract, the /ES, is ES is 5 times larger than SPY. Okay, so 5 times the notional value. You're controlling 5 times the amount of the underlying symbol. Okay, so SPY is this. If we look at ES, it's 5 times larger. So what I did is I used 2 contracts, right? If I use 2 contracts of this, I've got to use 10 contracts of SPY to get the same notional because it's 5 times the size. Okay, so with 2 contracts here, you can see the total max profit is $1,725. So pretty close, right? So that gives you an idea of the relationship between the two. Okay. And then lastly, if we look at SPX, SPX is 10 times the size of SPY. Okay, so SPX is 10 times the size of SPY, and SPX is twice as large as the futures contract. Okay, so with SPX, we're just going to use 1 contract to get the same notional value. Let's try to center this a little bit better. But what you can see is, total max profit on a strangle for SPX is $1,610. Okay, so we're right in the ballpark as far as our max profit and our notional value if we do 1 contract of SPX, 10 contracts of SPY, or 2 contracts on the ES future. Okay, so that's the relationship. Now, the other difference is on a stock or an ETF or an index, those underlying symbols do not have an expiration date, right? And if you were just going to buy the shares outright of SPY, you can hold those into perpetuity because there's no expiration date. You don't have to roll or anything like that. However, the options on them obviously have an expiration date. All options expire at some point in the future. And then when you're trading the underlying futures contract, not only do the options expire at some point in the future, but the futures contract expires in the future. Okay, so if we go to the trade tab and we take a look at the S&P 500 index future, the ES, you can see here are the different active futures contracts. Okay, so we've got one that expires 53 days out. We've got one that expires in 144 days out. That's the September contract. The December contract expires in 235 days. March of 2018 in 326 days. And you can see the prices of these are a little bit different because it's adjusting for that potential future price value. Okay? So that's the thing you got to understand is when you're trading these underlying when you're trading options on these underlying futures, you just need to understand that not only do the options expire, but that underlying future expires, and that's going to be the slight price difference between the SPY, SPX, and ES. Okay, and the other thing is they have a tiny bit different of an expiration cycle. So the one that we were looking at for ES expires 53 days out on the strangle that we showed. On SPY, the one we showed also expires 53 days out. The one difference between SPX is it's a cash settled index, and so you can see in the same June cycle, it only has 52 days to expiration. Okay, so that's another slight variance, not a huge deal, but that's the difference and why it's showing a max profit on each of those strangles that's a little bit differently. Okay, it's not exact, but the notional value and everything that your total risk is all going to be the same, based on the notional value you choose. Just remember, SPX is 10 times the size of SPY, and SPX is twice the size of /ES. Okay, so that's the difference there. The other major difference is the amount of capital that it takes to put on those trades. Okay, so if we take a look, going back to the ES, the futures contract, and we go back to the Analyze tab, and we say, okay, let's go ahead, we like the risk reward on this. Let's go ahead and put this on for 2 contracts. What's that going to cost us in buying power? So if you click on confirm and send, you can see the buying power effect is a little over $7,500. Okay. If we took a look at the SPX of doing 1 contract, okay, same potential max profit basically, and we right click and we confirm and send on that, it's going to cost us over $14,000. Okay, and this is in a portfolio margin account. I trade on portfolio margin. If you have a standard margin account, it's going to be significantly higher than that. And I'm not sure exactly what since I'm not in a standard margin account, I'm not sure exactly what that is off the top of my head here, but it's going to be significantly larger. Okay, and then same thing for SPY. It's going to be about the same. So the one thing about what the regulatory body that looks over the margin requirements for futures is you're typically going to get more leverage. So it's going to cost you a lot less buying power to put on virtually the same amount of trade. Now, remember, leverage can be good if you use it properly, but if you get over leveraged, if you don't use leverage the right way, it can come back to bite you. Okay, so you need to understand that it's great. You have to put on less capital to put on the trade, but you've got to be aware that you're using more leverage when you utilize the futures. Okay. Last point I want to make on trading options on futures, and then we'll go through what the markets are doing and take a look at our trade of the week. The last thing I want to mention is there are some really excellent trading vehicles that really can only trade on the futures. Okay, like oil, for example. Oil is an excellent trading vehicle, but trying to do options on USO, yes, they're liquid. Yes, they're tight bid-ask spreads, but USO is a $10 stock. Okay, it's a $10 underlying, and so trying to get any premium to sell in a symbol like USO, it's really not available. Okay, so you've got to use the futures contract to trade options on oil. And the same thing goes for natural gas. Okay, natural gas is an excellent trading vehicle. It's a great vehicle to trade options on. The underlying ETF is UNG, but it's only a $7 stock. Okay, there's no premium in there. There's not enough bang for your buck to make it worth trading on. So I always, if I'm trying to get exposure to natural gas, I'm always using the futures contract. Okay, same thing goes for the grains. You've got to use the soybean, corn, and wheat futures. The underlying ETFs don't have volume. They don't have tradable options available. Okay, so that's kind of the difference. There are a lot of underlyings that have the ETF like SPY or SPX that you could trade versus the futures if you don't have permission or you don't want to. But then there's bonds and notes which have the underlying, which is TLT, which is a great trading vehicle. So I like to trade both the futures and the ETF on the bonds. Gold, you can trade the underlying futures on the gold or use GLD. Okay, there's just some difference in the pricing as far as the size of those products. So you need to do what's best for you. I would tell you this, I would highly, highly recommend that everybody get futures permission so that you at least have the ability to trade that in your account if you don't already. Now the one caveat is if you have an IRA, you cannot trade futures on options in an IRA. Okay, so you have to have a margin account that's permission for futures. Okay, so that's the only drawback. You can't do it in an IRA. So I hope that was helpful. If you have any other questions on futures on options, let me know. I'll be doing a full detailed course on this in the future, but I haven't even started working on it. So it's quite a ways out in the future, but that will come at some point. Okay, so let's jump into the trade of the week and check out what the market's doing. Okay, so remember I mentioned the French election, the first round of the voting happened last night, Sunday evening. And so, the U.S. markets seem to like it. S&P is up over 21. The Dow's up over 180 points. NASDAQ's up over 60. Russell's up over 17. Bonds are down almost 0.75%. Look at the VIX. VIX down over 18%. We take a look at the chart of VIX. I mean, man, this thing, volatility is just getting crushed, which is pretty normal, right? If the S&P, if stocks are going up, the VIX and volatility are going to be contracting. So we'll take a look. For you Navigation Alert subscribers, we'll take a look. You know, there's a lot of theta, there's a lot of premium that's coming in with the volatility contracting. So so stay tuned for some updates on our Navigation Alerts portfolio. You can see the VIX futures down over 8%. Oil's down about 0.5%, and it's been on a little bit of a slide, continuing that slide from last week. Gold is down almost 1.5% after a pretty good run up here, so getting a little bit of a pullback in gold. But you can see the volatility is just getting crushed in everything. A lot of contraction going on with the stocks up, and after the release of the first round of the French election, you've got GLD, same thing, down over 1%. Natural gas is down over 1.5%. Let's take a look at natural gas. You know, we've had that huge run up, and now we're getting a little bit of a pullback there. The one thing about some of these futures as well, going back to what I was talking about, is as far as the difference, some of these you have to use the ETF to look at the implied volatility indicator that we use. So whereas I only trade options on the natural gas futures contract, we have to look at UNG, the ETF, to get an accurate reading on our implied volatility, which you can see it was starting to creep up, and it just got crushed today, just like everything else. Soybeans up a little bit today, which we do have a position on in our alerts portfolio. Corn and wheat as well. So, and the euro, of course, right? The euro obviously being impacted significantly from the elections in France. So remember, we've been trading FXE. We've got a couple different positions on in FXE, and implied volatility has just been pinned at 100 for the last week or so. In anticipation for this election, and after this first round, you can see what happened. Volatility is just getting absolutely crushed. So that's the impact on these. There's a buildup of this implied volatility because there's this uncertainty. As soon as the news comes out, as soon as the markets have a better idea of what's happening, that implied volatility just gets absolutely annihilated. So that's what's going on there. So what we're going to do for our trade of the week, a couple others here, EEM, the international indices, they're all up. Stocks are basically just up across the board. EFA, which is the international index, and same thing across the board. Stocks up, implied volatility getting crushed. So nothing new there. As far as our big stocks that we follow, Tesla up over 1%, Costco up over 0.5%, Amazon up over 1%, Goldman Sachs up almost 2.5%. The banks are loving this decision on the election, looks like. So what we're going to do for our trade of the week, because implied volatility is getting crushed all across the board, and based on the topic of this week of options on futures, we've already got a soybean position on in our portfolio, but I want to put on, because implied volatility, the price of the options in these grains are actually a little bit higher relative compared to a lot of these other symbols. With implied volatility getting crushed across the board, I don't really want to sell any more premium right now in the stock indices, at least for this trade of the week. The alert subscribers may get one coming up here this morning, but for trade of the week, we're going to look at corn, okay? And this is what I like to do. When implied volatility is low across the board in stocks and ETFs and things like that, that's when I kind of start turning to some of these other vehicles like commodities and grains and things like that. Now remember, the implied volatility indicator does not work for the grains. And so this is something that I really just have to manually monitor the price of these options. And relatively speaking, compared to most of the other symbols out there, the options pricing is relatively good as far as for option premium. And on these grains, you do get a good bang for your buck. So what I'm going to do is I'm looking at corn, and if we go to the trade tab, we always want to be in that 30 to 60 days to expiration. In this case, we're kind of in no man's land, right? You can really choose one or the other. You can choose the one that's got 32 days to expiration, or you can choose the one that's got 60 days to expiration. In this case, what I would do is I would come over here and say, okay, well, what's the implied volatility look like in the 32-day options versus the 60? And there you can see they're about 3 points higher, and the further you go out, typically they're about 3 points higher in the longer dated ones. So I'm going to opt to choose the ones with 60 days to expiration. Okay, that's going to widen my break evens a little bit more. I'm going to collect more credit when I put this on. And the strategy that I'm going to use is an iron condor. Okay, so we'll go ahead and set that up. Go to the 20 delta. In this case, I opt to go to the one higher than 20 if there's not exactly the 20. So simply right click, sell iron condor. And then we like to typically go 10 points wide. So 395 is the one we're selling. So we're going to buy the 405. And then we'll go over here to the put side to find our puts over here. We've got a 20 delta on the put side, which is 345. So we'll change the short to 345. And then the wing that we buy for protection, 10 points lower, so 335. And let's go ahead and analyze that trade. So we'll right click, analyze. And so here's what we're looking at. So we're looking at a max profit of about $156 with a max risk and capital required of about $343.75. Okay, so I'm going to go ahead and kick that up a couple contracts so that we have a max profit of $468, and we're utilizing about $1,000 on this trade. Okay. So I hope that was helpful. I'm going to go ahead and get this order filled and send it out to our alert subscribers. If you like seeing these trades and you want to become part of Navigation Alerts, we still have a 2-week trial for just $7 available. Just go to the website, NavigationTrading.com. You can check that out, and then you can receive all the alerts that the subscribers receive on a daily basis. Hope that was helpful. Have a great week of trading. Talk to you later.